Hello everyone. Hope you all are doing well. So today we will going to discuss about IFRS 17 objective. What is the difference between IFRS 4 and IFRS 17, and what are the existing issues that IFRS 17 is taking into account. So we can start. I will share the screen. So overview of IFRS 17 or objectives of IFRS 17. So as we all know that IFRS 17 is yesterday we have discussed in my first video that IFRS 17 has been implemented this year in January. So the purpose of IFRS 17 establishes principles for the recognition, measurement, presentation, and disclosure of insurance contracts issued, reinsurance contracts held, and investment contracts with discretionary participation features that an entity issues. So in this point, basically, when we will do the IFRS 17 liability calculation, so the calculation will be done at initial recognition and at subsequent measurement. So there are two types of calculations that we are going to do, and the calculations we will be doing in IFRS 17. So that will be at an aggregate level. So that I will cover in my further videos. So key things that we have to take into account that IFRS 17 is for insurance contracts, and the calculation we have to do for the insurance liabilities for different lines of business, that is for life insurance, for general insurance, and under life insurance again we have two separate calculations. One is for non-profitable products, and another one is for with profitable products. And the calculation will be done at an aggregate level, that is not at a policy level or not at a contract level. So we will do the calculation at an aggregate level, or in IFRS 17 terminology at a cohort level. So all these terminologies I will cover in my further videos. So the purpose of IFRS 17 is to define the calculations at a at a initial recognition level, at subsequent measurement level. Measurement, so what are the methods that we are going to use for the calculation? So that is method for calculating insurance liability for life insurance business, for general insurance business, and again under life insurance for with profitable products, for non-profitable products. Presentation is that the result, that is the final output of IFRS 17. We will call it financials, that is disclosure reports, balance sheet, roll forward statement, profit and loss account statement, other comprehensive income statement, and there are other reports that we can generate out of these reports. That is your cash flow analyzer statement, risk adjustment analyzer statement, your CSM statement, your policy data check report, difference between relationship between CSM and risk adjustment, relationship between your risk adjustment and the discount rates. So these are the reports that we will prepare under IFRS 17. We will call it disclosures or financial statements. The objective of IFRS 17 is to ensure that insurance companies provide relevant information that faithfully represents insurance contracts. So here, again in standard, every definition has been given for each and every term or concepts that we are going to study or that we are going to use in our practical calculation. So definition of insurance contracts also given in the standard. This will allow users of the financials to assess the impact that insurance contracts have on the financial position, financial performance, and cash flows. IFRS will create standards for insurers and other entities as well to identify insurance contracts that fall within the scope of the standard, divide the contracts into groups that it will recognize and measure, recognize for each group the amount relating to the fulfillment cash flows, contractual service margin, fulfillment cash flows, that is the risk adjusted present value of the future cash flows that are expected to arise as the entity fulfills the insurance contracts, and your contractual service margin is the unearned future profit in the group of contracts. So again, I will cover these uh, uh, variables or these concepts in my further videos. So this is in the overview of IFRS 17. I have captured these points, and uh, I will cover all the things, all the concepts that I am showing here. So in my further videos, remeasure the group by updating the fulfillment cash flows and the contractual service margin over time. Operational impact. So the implications of this IFRS transformation initiative are not just technical calculations, but will affect, amongst others, actuarial reserving point of view, finance, general ledger, reporting processes, tax, treatment, IT, data storage, finance systems, HR remuneration, and investor relations presentations. So this is also very important point that IFRS 17 is not just stick to one domain. That is not in actuarial, not in IT, not in finance, not in uh, like only to tax, investor relations. So all these uh, people from different domains are working together to get or to generate or to produce the final outcome of IFRS 17. That is your disclosure reports. So actuarial people will update their existing models from the IFRS 17 standard point of view. So whatever requirements as per the standard are there, so they have to incorporate those changes into their existing models. They have to do the calculation based on the standard finance from the general ledger reporting processes. So they have to create a chart of accounts, and they have to define accounting events. And those accounting events will again have definitions from the debit and credit point of view. And one accounting event has more than one definition. And those definitions will be linked with your actuarial output. So those actuarial output will be mapped to those accounting events, and accordingly, the entries, the values will be assigned to the debit or the credit column. IT, from the data storage point of view, that systems will need to be updated from as per the standard. So from the granularity point of view, and also uh, like there are systems that they have to update the finance systems from the general ledger point of view, that whatever granularity they have to use for the creation of general ledger postings. So they have to update all the systems. HR from the remuneration point of view, investor relations, presentations. So presentations, as I have already discussed, that once all the like actuarial systems will be updated, finance systems will be updated, then combination of these actuarial and finance will generate the output, and that output we will be using for the final disclosures creation. So this is how IFRS 17 will work. So again, I have not covered the full or most of the objectives. So it is just the general things that I have covered here, so that at least you will get an idea of what are the what are the things that we need to know from the calculation point of view, and also what is IFRS 17 in general. How IFRS 17 improves accounting. So existing issues, we know that a variety of treatment depending on type of contract and entity interpretation. IFRS 17 requirements, consistent accounting for all insurance contracts by all companies. As yesterday I have discussed that uh, different accounting policies are used in previous IFRS 4, and different methods are used for the calculation of insurance liability. And this is the reason that the financial statements will not be comparable across different geography, different companies, and different entities. So IFRS 17 will cover all these issues. Estimates such as discount rates for long duration contracts not updated. So estimates updated to reflect current market based information. Discount rate based on estimates does not reflect economic risks. Discount rate reflects characteristics of the cash flows of the contract. Lack of discounting for measurement of some contracts. Measurement of insurance contract reflects time value where significant. So these are the existing issues that IFRS 17 will overcome these issues. And in order to overcome these issues, so there are concepts or terminologies given in the standard. So discount rate is also given as per the standard. There are two methods that the companies can adopt: uh, top-down approach, bottom-up approach. Also, current rates, current market-based estimates updated to reflect current market-based information. So they will do the calculation at best estimate liability. And in IFRS 17, we will be using at locked in interest rate, at initial recognition, and in subsequent measurement. So as per the method, the interest rate will be used. The next key differences between IFRS 4 and IFRS 17. IFRS 4, profit recognition at the start of the contract, so which is the critical point that we have to look into that in previous IFRS 4. So whenever like whatever valuation they are doing at the start of the first year, so the whole profit for the future term of the contract, they are charging it into the profit and loss account at the end of the first year. So which is not logical. So under IFRS 17, upfront revenue recognition is not permitted. Mandatory early recognition of losses on onwards contracts. Revenue includes premium and may include an investment component. Revenue excludes any investment component and represents the reduction of the liabilities held as the entity provides insurance service and respective risk is released. Reinsurance calculated on a net basis. Reinsurance is calculated separately. Change in value of market variables goes through profit and loss account. Change in value of market variables may go through profit and loss or OCI. So here again, this is in general the points covered. So there are further like concepts in that whatever components that is in the insurance contract, we will segregate like the investment component and the treatment of charging, whether to profit and loss count or whether comprehensive income. So that will be defined as per the component, because uh, there is a concept, one concept is unbundling. So unbundling is basically, so we are separating out the investment component from the insurance part, and that component will go into the as per IFRS 9 and into the other comprehensive income. and that insurance component will go into the profit and loss account statement. So again, in investment component that is going into the, as per IFRS 9, into the OCI. So there is again a separation. So that separation will be into IFRS 9 or IFRS 15. So that I will cover in my further videos. Just for the clarification, what is written here. So I'm telling here. Disclosures help users understand amounts in the insurer's financial statements. Disclosures are more detailed and granular. Discretion in determining separation of components. Separation of components is required only if distinct. So thank you, everyone. I hope you like this video, and any comments, any suggestions, or any doubt or any queries in any of the topic or points that I have discussed today, please let me know. I have already shared my email ID also, so you can drop me a message whenever if you have any doubt or queries. Thank you, everyone.